We started with what were interstate options. So I think we stopped on this slide and the types of interest and what are interstate options, and we just went through the nomenclature. Now, what these products are, we haven't discussed yet. So that is something which we do now. So we start with caps and floors. So these are popular products which, as I mentioned the last time, they are you'll find them on banks' domestic books as well as on Gift City, especially for banks in India. So when you say an interstate cap, you can say it is very similar to a call option. Now, why I say it's similar to a call option? Because firstly, the nomenclature is different. For equity, FX, commodities, etc., we call it as a call option, whereas for interest rate, we generally call it as a cap. And the second point is whenever I have, let's say, a European call option, that means it's one single option which will be exercised at a certain point in time. But for a cap, it's actually a bunch of options. So you can imagine it, I'm grouping together a few options and then I'm creating one single product. So we say cap is a bunch of caplets. So what that is, etc., we'll see. So maybe let's try to understand cap through a simple example. So once you understand cap, a similar application or a similar understanding can be applied for floor as well. So let's say I have a 1 year cap, and let's say I have decided on a strike price of 2%. Let's say the frequency followed is quarterly, and imagine it's a LIBOR cap. Okay. So again, when we're studying this option, we have to basically look at the individual components which make this cap product. So when I say individual components, I'm specifically looking at caplets. So let's see what are caplets. So we'll plot the timeline first. So we have Q1, Q2, Q3, and Q4. And let's say my first fixing is L1, then let's say L2, L3, and L4. I have a strike which is given to me as well. Now, when I say it is similar to a call option, now we know the payoff condition for a call. We have C equal to max of S minus K or 0. So here only change that I make is in place of S, I will require an interest rate. So maybe you can replace that by a R or by a forward rate F, whichever you like. But we are going to continue to use a similar payoff condition, max of the underlying minus the strike price or 0. Now, why I say it's a bunch of options? Because I have 4 time points which I'm looking at: Q1, Q2, Q3, and Q4. Now, these are points at, or maybe these are at some point of time in the future. And for each of these points, I need to apply this payoff condition. That is, I may want to apply max of L1 minus K or 0. Similarly, I may want to apply it for maybe max of L4 minus K or 0. Now, K is frozen because K is a part of my term sheet. This has already been decided when I've signed on the piece of paper to enter into this contract. Now, to determine how much these are worth, we need to know firstly the rates L1 through to L4. Now, this is again an area whereby your implied forward rates get used. Now, why I say implied forwards are required, because again, L1 through to L4 are based on a floating rate benchmark, and a floating rate benchmark here is LIBOR. We know that for any floating rate benchmark or any floating rate product which we have to work, be it a floating rate bond, a forward rate agreement, even a floating rate on a swap, everything requires a grounding on forward rates, because without forward rates, there is no way of figuring out what is L2, L3, and L4. L1 is something which I may know at the start, because while I'm entering into the contract, I can have my first fixing, which I call. So maybe if I'm entering into the contract today, then I have T minus 2 days back LIBOR, which is available, which I can call as my first fixing of LIBOR. So maybe L1 will be known. But L2, L3, and L4, this is something which I need to figure out through the forward rate condition. So if you recollect the point which I had mentioned earlier, why interest rate derivatives becomes challenging as compared to equity or FX or commodities. That is because of this forward rates thing. And we know that we can't really jump to forward rates directly. There needs to be a bootstrapping process. So zero rates have to be done, then you can go to forwards. But these are the same forward rates which I'm talking about now. So once I have a forward curve, I can figure out L2, L3, and L4, and then I can apply this payoff condition to see whether these options are in the money or not. Why I say options? Because I'm treating 1, 2, 3, and 4 as separate products in themselves. So this is option 1, this is option 2, this is option 3, and this is option 4. So these have separate identities of themselves. That's why we say a cap is a bunch of options, or we say a cap is a bunch of caplets. Technically, these four, option 1 through to option 4, are what we call as caplets, just a technical name given to it. And we say that a cap is a bunch of caplets. And the payoff condition will be driven by this by a condition which is very similar to a call. Only thing is we require the idea of what the forward rates are going to be. We can simply use them in the condition, and we get to know what the payoff for these options are. And we can treat each of these options 1 through to option 4 separately. Rather, we have to treat them separately because the product has been designed in that way. And finally, we say my entire product, which I call as a cap, is a combination of four options, which I call as four caplets. So I can have I running from 1 to n. I can have n number of caplets as well. Here I have a 1 year cap with a quarterly frequency. Tomorrow, if I have a 2 year cap with a quarterly frequency, then I'll have eight caplets. Four caplets 1 year, four caplets in the next year. But otherwise, the structure more or less remains the same. So, any questions in the structure? Yeah, Veer, please go ahead.
Sir, you are telling about Q1, Q1 rates are available, future rates are available, and Q3, Q2, Q3, Q4 are need to be calculated as you explained in earlier lectures.
Yes.
So, but my point is, what is the guarantee that we will arrive at a reasonable figure? Or
So,
because it can go anywhere, both the ways. It can go extremely low or extremely high in case of currencies.
so this is actually applicable for interest rates, not for currencies. And L2, L3, and L4 will be dependent on the term structure which you currently have at hand. So tomorrow, when we have a new LIBOR curve, we'll have a new term structure which gets created, and based on that, your forward rates will change. But that's the idea, right? We have to keep in track with what the rates are currently trading in the market, and then use them in the calculation. So they are bound to change. They have to change.
Sir, and one more thing. Since it's relating to interest rate futures, would it be safe to say that interest rate futures are relatively stable compared to other futures?
Not really. No, these aren't exactly futures because these are over-the-counter products. And so you can maybe compare this with interest rate options which transact on the exchange, because otherwise there's no optionality which is embedded. Interest rate futures are like a commitment. There's uh, no contingent thing or no optionality. But maybe you can treat them similar to interest rate options. Uh, Maybe from a riskiness perspective, possibly liquidity can be one point which can be looked at, because if you talk of options which transact on exchanges, these have a comparatively higher liquidity as compared to something which happens on the OTC. But again, that being said, these are pretty standardized products now, because although we say these are a part of structured varieties, they are pretty standardized. So I don't think too much of a liquidity is an issue here as well. But of course, if you have to look from a trading perspective, then exchange definitely offers a better liquidity.
Sir, and regarding your last point, trading, are they primarily used for hedging or speculation basis?
Either one. I mean, if one has a certain view on interest rates and wants to maybe bet on that, they can do it for trading purposes or speculation purposes. Others might have a genuine hedging requirement as well. So both ways. We can talk a bit about applications once we go through these structures for caps and floors.
Okay, thank you, sir.
So just a question on these caplets. So when we say that so when we say that we have four caplets in a year, we mean if the interest rate breaches the cap on any one of these occasions, the option is invalid, right?
No, so basically, so there's no knockoff feature as such. Now the option will remain valid throughout the year. Only thing is your value of the option will keep on fluctuating. So based on where L2, L3, and L4 are vis-a-vis the strike price, your option payoff condition changes. And based on the payoff condition, your option valuation or MTM of your cap will change.
Okay, so but then sir, these cannot be exercised at any point, right? So these are more like European options wherein you only have certain intervals on which you can exercise them.
Yes, yes,
Correct? Okay,
correct.
sure. Sir.
Any more questions? Okay, all right. Now coming to interest rate floor. Now, interest rate floor, as I say, is very similar in payoff to a put. Now, for a put, we know the condition as max of K minus S or 0. Now, the structure will remain more or less similar. So I can just write this as a 1 year floor, and I can maybe other things I can keep the same, strike price, frequency, LIBOR, etc. Only thing is my payoff changes. So the max condition which I've written here, this is going to go for a change. So it will be K minus L1. Similarly, this will be K minus L4. So basically your and this caplet will get replaced by floorlets. So the idea is uh, every time your floating index or LIBOR in this case falls below the strike rate, it is going to yield a certain payoff for that particular floor rate. And finally, what should be the MTM or fair value for a floor? That will be a combination of what happens at each of these floor rates. And again, the same argument applies. We have four separate options which you're looking at, option 1 through to option 4. So in this case, these options are individual floorlets in themselves. And we look at them separately and then we combine them to understand what will be the value for a floor. So a floor is related to floorlets and a cap is related to caplets. But otherwise, the structure for both of them remains similar. They continue to be a bunch of options on a certain underlying. And underlying in this case, we have taken LIBOR. You can have any other floating benchmark as well, maybe something like SOFR or maybe MIFOR, etc. Now, one point on volatility. So maybe from here, I'll just jump to flat versus spot walls. Uh, So there are a couple of ways in which you can use volatilities for these options because finally these are individual options, right? And we know that for an option, volatility is one of the parameters which it's dependent on. So there are four other parameters and you have volatility, sigma. So every option price V is a function of five parameters. We have a vol which comes in as one of the inputs. So here as well, you need to pick a certain volatility number which you would like to use because finally these are options. So in that option pricing model, it is going to demand a certain vol input to be used. Without that, that option pricing model will not be able to work. So there are two ways in which you can use volatilities. One is a flat vol. So when I say a flat vol, so let's say I just plot these time points, Q1, Q2, Q3, and Q4. Imagine that these are the four time points for my caplets oblique floorlets. Now, when I say I'm using a flat wall, that implies I'm using a constant sigma for pricing each of these caplets or floorlets. So the sigma remains flat or it remains constant. It is not going to change. So this is what we call as a flat volatility. Then we have spot walls. So spot walls imply that I'm using a separate volatility number for each of these individual options. So I have sigma 1, sigma 2, sigma 3, and sigma 4 for four of these caplets. That way, I have a separate wall number which I attempt to use for pricing each of these caplets or floorlets. This is what I call it the spot volatility. Now, whatever the market quotes are always flat walls. So the walls which are quoted by traders will be flat volatilities. But there is a transformation which can be applied to move from flat to spot wall. So it's like a standard calculation, slightly complex, but it's pretty standardized. So you can get an input of flat wall, which is like a market input, and you convert them into spot walls. So now, could anyone guess why do I really require spot walls? Because flat walls are something which are readily available, right? I can use them. So why take that extra step and why really do spot volatilities? What is the idea behind sigma 1 through to sigma 4? And why not just stick to sigma? So
So because
anyone?
so I imagine spot volatility will give you better price discovery, I think,
Correct, correct.
because you can clearly factor in the volatility that's changing, right?
Absolutely correct. So just rephrasing Ali's point, he's absolutely right. So only thing is, advantage of spot walls is it will help you figure out any kind of mispricing in each of these caplets or floor rates. Because if we use one single value of sigma or a flat wall, it will be difficult for a trader to figure out which products are overpriced or underpriced. So from a trading perspective, it may not be able to add that much value. But if there's a spot wall available, that will have an impact on the final product price as well. And this will help a trader understand whether a certain product is overpriced or underpriced, which will give them further visibility as to what could be their trading action for a certain interest rate option. And that's why usage of spot walls becomes easy. But maybe those banks which are transitioning onto interest rate options, they may stick to flat walls initially because they may require time to get their systems up and running, because this is like, let's say this is like a new product which the bank decides to transact in. So they would want to have their systems ready. Along with that, they would need to have their uh, back office book creation as well, because finally whatever trades are going to happen on caps and floors, they are going to go and sit in their portfolio. So having that portfolio mapping done for P&L calculation, position reconciliation, etc., that can be a challenge initially for a bank. So maybe at the initial stage, a bank could stick to flat walls, but generally the effort for a bank will be to move to spot walls at a certain point of time in the future. Okay. Now, giving you an idea of how exactly the pricing for this product happens. So let me switch to my whiteboard. I'll show you the things on a binomial tree. Although binomial tree is something which we don't use for pricing of such products, but again, they are useful to understand the structure. Again, so I think the screen sharing has stopped. It's not allowing me to share anything. Let me just exit the meeting and rejoin, because that screen share option has suddenly grayed out. Just give me a minute. So just to understand the structure, so this something similar will be applied in continuous time as well. But with as you know, with continuous time, we can't really show a diagram as such. So maybe I can show you an illustration with a binomial one. You won't have to use a binomial tree for pricing a cap or a floor, but this understanding will be helpful. So let's say my task is to calculate the price of a 2-year cap. And let's say I want to split this cap into a 1-year cap and a 2-year cap. That is, I have two options uh, with this tenor. So that way, if I have to split this product into two parts, I could do it this way. So this could be my 1-year caplet, and I could have a 2-year caplet, something like a two-step binomial. And if I combine them together, I can say I have a 2-year cap. Now, again, a very crude way of representing this, but this will give you an idea, because, as I mentioned, I want to treat them as separate options in themselves. So I have a 1-year caplet which I'm treating separately. I have a 2-year caplet which I'm treating separately. So that way, these are two independent options in themselves. So I can call them as maybe OP1 and OP2. And I can price them separately. I simply add them up, and that gives me the price or MTM for a 2-year cap. So once I have two separate options, I can naturally work on two separate volatilities. Now, whether I want to use a flat wall or a spot wall, that's a different thing. But then I have two separate options which I'm treating individually, and I'm trying to work on that price. And this is how you can roughly visualize how you could actually split a cap into individual caplets. But in a real world scenario, you will tend to use the Black's model. So, Black's model comes from scientist Fisher Black. So he was one of the scientists who was a part of the Black-Scholes-Merton team as well. So what Black did was he picked up the Black-Scholes-Merton model and tweaked that a little bit. So the formula, if you see for a Black-Scholes-Merton option or a European call option or a put option, vis-a-vis that for an interstate option is very, very similar. Now, one key point of difference which you'll see is the usage of forward rates. Because if you remember in our Black-Scholes variety, we never really spoke about forward rates, right? We had something like a ln of S by K. So this was like the first term. So if you recollect, we had something like a D1 and D2. So within D1 and D2, we had something like ln of S by K and plus the other term upon the denominator. Now, so if you see the formulas for normal Black-Scholes-Merton, we never really worried about forward rates because for equities, that's not much of a problem. I mean, the concept of forwards is not going to add much value. So we stick to spot rates there. However, now if I have to tweak this formula a bit and I have to use a similar setup or a similar framework for an interstate variety, I simply cannot depend on spot rates anymore because I will need to know what the forward term structure is. Because without having an idea of what the forward rates are, it will be impossible for me to work on individual caplets or floor rates. So this is the only change which you'll see. You'll have to replace the spot by forward rates in your Black-Scholes-Merton model. I don't think I've written that formula here, but maybe before I share the slides, I'll just include the actual formula for caps and floors. So, and that time you can compare them vis-a-vis the Black-Scholes-Merton model. So only a small tweak which you'll see, which will factor in the forward rate component. And once you have that, you say that you have transitioned onto a Black's model. So there are, again, now if you have to do some hands-on bit with caps, that is possible. So you can do it via scripting. You can do it through Excel as well, but Excel will be a bit painful. But I know in Python you have ready libraries which can support your cap pricing through Blacks. So there is an interesting library which we call as Quantlib. So Quantlib is something I'm not sure if you have a wrapper around this to use in R programming, but in Python this definitely exists because I've used this on projects as well. But this is something which you can check out. Along with that, and the advantage of using these things like Quantlib is it saves a lot of your development effort. So that way they already have a library for the Blacks model. You don't have to actually build this model from scratch. You have to only consume that to build your model. So that basically saves a lot of time because if a certain model is ready, you should not waste time to rebuild that model. And rebuilding might give you additional clarity and a feel good factor. But when you're working on a project, you don't have that kind of a luxury. You'll always be under time pressure. So at that time, using these ready functionalities like Quantlib, etc., becomes very, very handy. Only thing is how exactly you want to fit in other things of the model will be dependent on the model developer. But otherwise, certain functionalities are available inside Quantlib. So things like Black's model, I think even Black-Scholes-Merton is possible through Quantlib. And there are other functions like interstate modeling or even FX modeling, which Quantlib supports. I'm sure there'll be other libraries as well, but Quantlib is currently the leader from the Python side. From our programming side, I don't know what is the counterpart for Quantlib, but this is something which you can check out. So those of you who would like to do some modeling bits for caps or flows, etc., this is a library which you can definitely leverage. And that way you don't have to worry about how exactly the spot and forward rates are being handled, etc., because that library has already that functionality which is factored in. So only thing is, so why I say it saves time, because you only need to understand what the product is. Once you understand what the product is, converting that into a line of code is not very difficult because those kind of functionalities are already there. You have to simply call them and use them. And you have to only ensure that those functionalities are being fed in the correct inputs. Because if your inputs are incorrect, then naturally all of the outputs are going to be correct as well. So I think that way you can try some simple hands-on data run. Now, binomial thing, this is fine. You can, this is something which will help you get clarity. But in the end, in the industry, you'll be expected to use the Black's model. Most of your firms will have a certain model for interest rate options, or you could end up using a Bloomberg calculator for pricing of these products. But again, you'll end up using blacks for both caps, floors, and collars and swaptions as well. So basically, any kind of interest rate options or IROs, as we call it, blacks happens to be one of the popular models. So I'll include the blacks models equation for the cap and floor when I share the slides. I don't think I've included that in the presentation, but I will do that. Now, can you think of a few applications for caps and floors? Now, any financial or non-financial scenario where you feel a cap might come useful, let's say from your risk management purpose.
Something like what's happening now in Russia. So I think the central bank over there has suddenly increased the rates extremely. So in that case, if you have a forward contract, then one party is going to lose big time, right? So over there, a cap or a floor could come in very handy, like
Correct,
to hedge against adverse impacts,
correct,
events.
correct. Good. Yes. So yes, a good example, and maybe even a simpler example closer to home as well. So let's say that I have a certain floating rate loan which I want to manage. Then I can actually try to use the interest rate cap in that scenario. So imagine that I have a 10-year loan. Let's say I'm a company, I have taken a 10-year loan for a certain project, and let's say it's a floating rate loan. And let's say the floating rate at the time of taking the loan was, let's say, 5%. And imagine that this is a rate which I am comfortable with. So I feel that my project can support 5%. Any fluctuations which are higher than 5% will make it difficult for me to service the loan. Now, I have a floating rate loan, right? So maybe my loan could be linked to LIBOR. Now, LIBOR I know can keep on moving. So LIBOR at the moment is 5%. But tomorrow it can go higher or lower. I don't have control over it. But my target is 5%. So I'm comfortable with 5%. So what I do is I can enter into a cap at a strike rate of 5%. So at the time of taking the loan, I enter into a cap transaction whereby my cap frequency will exactly match with the loan frequency. So if this is quarterly, then I'll also take this frequency as quarterly so that those time points exactly match. I need to match those cash flow time points. So 5% is my target rate. I'm comfortable with 5%. I'm confident my project can service 5%. But anything beyond 5%, it may be difficult for me. Now, let's say going ahead, the rates start going higher. So if there is an uptrend in rates and rates go to 6%, it's a floating rate loan. So I'm expected to service the loan at 6%. I don't have a choice, right? So now there's a differential of 1%. So I'm falling short of 1%. Now imagine only the left hand side of this figure. So I just divide this into two parts. So imagine the left hand side of the green line. So in this, there is a differential of 1%, which I'm worried about because my project is not strong enough to support this requirement so that I can repay that additional 1% on the loan. So now this 1% has to be brought in from somewhere. Otherwise, the bank is going to apply a penalty on me. So at that time, this cap product is going to come to my rescue because I have a strike at 5%. Now, every time the rate goes beyond 5%, I have a certain payoff which this cap is going to give me. So now the rate has risen to 6%. So 6% minus 5%, which is the payoff of 1% on the cap. So that way, my requirement of 6% gets met. How? Because firstly, I'm comfortable with the rate of 5%. So this is something which my project cash flows will continue to satisfy. And the additional 1%, that is something which my cap is giving me. So 5% plus this 1% takes me to 6%, which is the requirement at that point. So this is how I can use a cap for hedging against any fluctuations in interest rates. So a floating rate loan can be a good example. Similarly, I can apply a similar idea for a floor as well. So for a floor, let's say I have a certain investment in a floating rate note. So let's say as a part of my overall balance sheet management exercise, my front office has decided to transact in a floating rate note. So that means the coupon rate on this product is going to keep on changing. So again, let's say my coupon is linked to LIBOR. And let's say at the time of purchasing this note, LIBOR was around 3%. And let's say this is my targeted return. So I want 3% on this floor because it may so happen that I have some other liability which I'm trying to meet through this investment. So it can happen that I've invested my money in this bond, and every time the bond is going to make me a floating rate payment, that has to be transferred to some other liability. So I may earmark my assets and liabilities that way. Now, 3% is my targeted rate. So this is what I expect. Now, anything below this will make things difficult for me because then I have to fund that shortfall from somewhere. So what I could do is to hedge against any kind of fall in interest rates. I can actually purchase a floor along with this, and my floor will have a strike price of 3%. Now, let's say the interest rate drops and this goes to 1%. Now there is a differential of 2%, right? My targeted return is 3%, but since LIBOR has dropped to 1%, I'm falling short by 2%. I have to somehow make good this 2% because that's my requirement. At that time, the floor can come to my rescue because I know that the payoff for a floor is very, very similar to that for a put option. So every time the rate is going to fall below the strike rate, it is going to give me a positive payoff. So the differential of 3% minus the current going rate of 1%, which is 2%, is something which the floor can generate for me. So accordingly, my return remains intact. That is, my basic investment in this bond is going to yield me 1%, whereas the differential is something which the floor is giving. So that way, 2% plus 1%, I continue to yield 3%. So that way, my other liabilities, which I have earmarked for this particular product, are satisfied. So this is how I could use a floor for hedging a certain position. So any questions,
Just a
please?
question on this.
Yes.
Sir, um, practically speaking, so if you imagine our current situation, okay, um, macro trends are pretty visible, and maybe over the next 1 year, next 2 years, interest rates are set to go higher up, right? So in this case, I understand that I, as a borrower, would want a cap on my rates. But why would anyone sell me that kind of an option? Because it's obvious they will be incurring a loss, right? So either the
Um,
premiums will be so high, it will be, it will not be sustainable. Otherwise, somebody's going to have to incur a big loss, right?
Correct. So again, now that depends on the perception of the market participant because firstly, everyone has a certain set of expectations. So because if everyone has uniform expectations, we cannot have an active market. So imagine that every market participant they may have a similar perception, but they are individual perceptions in themselves. So that way, there are certain mismatches which exist, and it is because of that that trading of such products happen. Not just this, but for any product, because if everyone had a uniform price in mind, you can never trade. So everyone would have a different sense as to how a certain interest rate environment is going to evolve. Maybe the timing at which interest rates are going to change, that could be different for everyone. So everyone might have a perception around that. But if someone has a genuine hedging requirement and if they're willing to take the chance of paying a premium, then they would want to enter into such a transaction. Because many a times it happens that we have a genuine concern and we want some way of hedging that exposure. So at that time, we can't really worry too much about the cost. So at that time, although the cap might be expensive, they may still have to enter into a transaction or maybe use some other way of hedging their exposure, maybe through an interest rate future or an interest rate option. So I think that would depend on three factors, as I mentioned: investor perception. So perception specifically pertaining to the timing at which the rates are going to change, and generally also the level to which the rates are going to change. Or then the liquidity for these products. Again, liquidity for caps or flows is not much of a problem because there are market participants who are willing to transact with them. And thirdly, I think if you are requirements are exactly being matched with what is available on the exchange, then that is something which a market participant might want to try out as well, because something which transact on the exchanges is standardized. So if your requirements are standardized and if that is being met, then you can go in through the exchange route as well. So I think it will be difficult to have one single answer for this, but these three or four causes can decide how exactly these products will be consumed by a certain participant.
Okay, then sir, according to you, would there be a demand for a floor right now, like like in the current like in the current scenario?
Current scenario, it looks difficult because we don't expect. So, if I take the Indian scenario, we don't expect the RBI to cut rates further because they have already gone for a series of rate cuts over the last couple of years, and they haven't really increased rates yet. So, there is a building perception that rates are going to rise. So, I think in the current scenario, demand for floors might not be too high.
Exactly. So then, sir, this market naturally would become very less liquid over the coming period, right?
For floors, yes, but you never know. I mean, things are pretty uncertain now. If a COVID fourth wave comes in or fifth wave comes in, and if it again
Mhm.
puts a stop on the economy, then RBI may be forced to cut rates again. So those kind of uncertainties are something which we don't know.
Okay. So, okay. And sir, just one last question. Most of like you know, the- these products are being mostly used by banks and hedge funds, right? So do they only use it for hedging, or can it be used for speculation as well?
So you could actually use it for speculation also. So in case you have a certain expectation as to how on the direction of the way in which rates are going to move. So maybe at that time you may want to enter into such a position. You may not have a certain underlying which you're trying to hedge, but you simply have a view on rates. So you can simply purchase the option and you can see whether your estimations are right. Or maybe if you have that kind of appetite, you can sell that option and then see if the market moves as per your expectations and you just get to keep the premium then.
Okay, sir. Sure.
Any other questions? Okay.
Sir, do we use the similar method that you prescribed in the earlier lectures for calculating the future interest rates?
Yes, so the forward rates, so here there won't be future rates actually. We'll call that as forward rates, but yes, the similar approach will be used. So we get a yield curve, we compute spot rates, and then we arrive at the implied forwards. And those are the same forward which will get used here as
Okay, thank you, sir.
well. I'll just switch back now. Uh, Now, giving an idea of what is a swaption. So, a swaption is again, it's an interest rate option. It is slightly different as compared to a cap or floor. So, a swaption you can imagine is a combination of a swap option. So, you might want to split this into two parts: swap and option. That's why we call it as a swaption. So again, now since we are saying it's a swap and the option, basically there is some kind of optionality which is embedded in this product, and that's why we classify this as a part of an interstate option as such. So how exactly the optionality gets into this is, let's say I have purchased a swaption, or maybe I could actually look at this notation and then explain the definition. It will be easy. Then we can basically go through points. So points two, three, and four will maybe points two and three will see in a bit, but maybe to understand the definition better, we can go through the example first so that we know. I can show a timeline as well for this. So let's say I have something like a 3x6 option. So if you see the nomenclature for this is very similar to what we have done for a FRA or a forward rate agreement. Of course, the products are different, but the way in which we are trying to address that product is similar. So when I say a 3x6 swaption, this means I have a swaption which is expiring in 3 months, in 3 years, and that gives me the right to enter into an interstate swap at the end of the 3 year period. So if I had to show this definition via a timeline, so 0, 3 years, 6 years. So this is swaption start. Option end. IRS start and IRS. So this is how I would like to interpret this relationship. So my swaption starts today. So I sign on the contract. Let's say I have purchased the swaption. So again, the behavior would be similar for a buyer and seller for option. We know that buyer of the option has the right but no obligation, whereas the seller only has an obligation because they have taken a premium, right? So the same logic applies here as well. So imagine that I am long the swaption. So let's say I have purchased the swaption. Uh, so I may have a certain view on interest rates. So generally, whenever someone is entering into a swaption, they have a certain estimation as to how the rates are going to move at a certain point of time in the future. And let's say today I enter into this swaption, whereby on my agreement I say that I want to keep this swaption strike to be 3%. So this is the rate which I have signed on today. And I'm going to use this rate to compare what the rate is going to be at swaption expiry. So on day zero, on a piece of paper, I sign on saying that this is the rate which I would like to check at the swaption ending. And at that time, I will decide whether I want to enter into a swap or no. Because I am an option buyer, I have the full right of deciding whether I want to exercise the swaption or not. So now, this is what I do at time zero. Then at time 3, I have I can actually compare this K against what the going rate is, right? So let's say the going rate is R. So I have R%. Now, to determine whether it is beneficial for me to exercise the swaption or not, I will compare this K%, which was the rate which I had agreed on at time zero when I had purchased the swaption, against what it is today. Now, R is a realized rate, right? Now, this is something which is visible now. Now, this K equal to 3% was my estimation because I was standing 3 years back. And now standing on time zero, it was just my view as to what I expect the 3 year rate to be. But once I have moved from 0 to 3 years, I am standing on this point. So I have the actual term structure available with me. So I can have a realized value of rate, or the rate at which the market is transacting, of R%. Now this R% can be compared against this K, which I have frozen as 3%, and using that I can decide whether I want to exercise the swaption or not. If I exercise the swaption, that means I enter into an interest rate swap for a period of 3 years. If I say that I do not want to exercise the swaption, then my contract terminates at the 3 year time point and the contract gets extinguished. There is no separate swap which gets created. So this is in brief the structure for a swaption. So does the structure sound okay?
Yes, sir.
Now, how do you compare this R, etc.? We'll see on the next slide. So there is something called as a fixed rate payer and a fixed rate receiver. So we'll come to that in a moment. So I think the second point is just the extended definition for the swaption. Swaptions are European or American, but generally you would see that European options or European swaptions are something which the market does. I have rarely seen American swaptions as such, because American swaptions become exotic in nature. So demand for that may not be that high, but European swaptions, yes, to some extent they get used. In India, we do not have a very huge volume for swaptions, although some bank have them on their books. And if I recollect, I had gone through CCI's website a couple of weeks back. So I think they were talking something about providing a clearing and settlement for a swaption transaction, which happens on their platform. So I think that is something which I'll check as well, because I feel that CCI is supporting clearing and settlement for swaptions. But otherwise, globally, up till now, LIBOR-linked swaptions were very, very popular. Now, going ahead, we'll see how exactly these new benchmarks get adopted as well. So now, going ahead, we expect either SOFR, SONIA, Ester-based swaptions to be used. So that only time will tell how exactly liquidity builds. But I'm sure liquidity will build up because these products are something which the market uses frequently. And although the benchmarks have changed, I think the market will still continue to use them. Then the idea of a pair and a receiver swaption. Now this will decide uh, on my exact position for an interest rate swap. So on the earlier slide, I had spoken about the IRS, which starts at the end of my swaption tenor. So at this 3-year tenor, my swap will begin and it will continue for the next 3 years. So this is my 3-year tenor for the interest rate swap. Now, how exactly do I decide whether it is beneficial for me to enter into a swap or not is based on these two ideas, a pair swaption and a receiver swaption. So a pair swaption implies that, now let's say that I am the buyer of a swaption. So a pair swaption implies that I have the right to enter into the IRS as a fixed rate pair. So this is what you call as a pair swaption. Now it gives me the right but no obligation to enter into a swap at the 3-year time point as a fixed rate pair. Because we know for a IRS or a plain vanilla IRS, there are two sides, right? One is a fixed and other is a floating side. So this pair or receiver swaption connotation is linked to the fixed side of the swap. Now, only thing is whether you're a fixed rate receiver or a fixed rate pair changes as per your pair or receiver swaption variety. But for a pair swaption, you have the right to enter into the swap as a fixed rate pair. Whereas for a receiver swaption, you have the right to enter into the IRS as a fixed rate receiver. And it is based on these definitions of pair and receiver swaption that will help us determine whether it is beneficial for me to enter into the IRS at swaption expiry, or do I simply allow the swaption to expire worthless and that contract ceases to exist. So that will depend on how exactly the realized term structure of rates looks like, because that decides what would be the payoff for my swaption as well. And if I get a positive payoff and I'm the holder of the swaption, I would naturally want to exercise that. If not, then I can simply lose my premium. I can allow the swaption to expire worthless, and I may want to, and it may so happen that entering into a fresh IRS may be a better option rather than exercising the swaption. So that way, I mean, as long as you are the buyer, that gives you the complete flexibility. Now, if you're a seller for a swaption, naturally you have to abide by whatever the buyer decides to do. So if the buyer says they want to exercise the swaption, you're left with no other choice but to oblige. But if they say that we don't want to exercise the swaption, then you as option seller are happy, right? You simply receive the premium and the contract ceases to exist because that premium was paid at the start. You already have that cash flow with you, and subsequently no other action is required. So that gives you a positive payoff. So for a seller, you're happy. Again, for pricing of this, you continue to use the Black's model. So the same model which we use for our caps and floors can be applied here as well. So I think Quantlib supports swaption pricing as well, but something which I'll also check out because I've done cap pricing with Quantlib. Swaptions I haven't really explored much, but I'm sure there will be something which is there to support swaptions because that way it's a comparatively liquid product. So any questions on pair or a receiver swaption?
So just one question. When we say I have an option for a swap, does it mean I decide whether I want to exchange the cash flow at every interval, or is it just a one-time commitment?
It's like a one-time commitment. So I decide whether I want to be a party to the swap. And once, if I agree to that, then I become a party to the swap. Then that option anyways expired because that swap.
Throughout the entire period, right?
Yes,
Throughout
yes,
the
of
entire
course,
period, be it 2 years, 3 years,
absolutely,
whatever.
for the entire 3-year period in our example.
Okay,
Yes.
perfect. Yeah. Perfect. Cool.
Now, a couple of examples for, again, Black's model formula, etc. I will include. I think I have not included it here, but it's similar to the Blacks which we apply for the other options. A couple of applications for swaptions. One is speculation for sure, because if someone has a view on interstates and would want to speculate on that, swaptions can be one of the ways to do that. Then it also allows you to fix a certain rate on a swap. That is, let's say you're uncertain about how the rates are going to move in the future, and you want to lock in the rates today. Maybe a swaption can come to your rescue. Thirdly, it can also be used for termination of a swap contract because, again, as we know, a swap contract is like a forward commitment, something similar to a forward or future. Now, there is no separate option, right? When we talk of a plain IRS, there is a commitment which I have to meet. Now, when I'm entering into a swap, let's say I have a 5 year swap. Now, I have entered into that swap today, and I know for the next 5 years I continue to exchange cash flows. Now, let's say 2 years down the line, I feel that my project condition has changed and I had a certain requirement which doesn't exist anymore. So at the 2 year time point, I feel that, I mean, it's useless for me to have the swap because I don't really have a separate project or separate position which I'm trying to hedge through that swap. And I will want to exit that swap. That can always happen, right? Because business scenarios can keep on changing. So one way could be to use swaption so that I can take a offsetting position in a swap, which can help me negate the two cash flows, which can help me offset the swap position. The second way to exit a swap can be to request my counterparty that I want to go in for early unwinding. So early unwind is also something which clients frequently do. So generally for early unwinding, what happens is, let's say there is a bank and a client who have entered into an interest rate swap. And let's say we are the client. We go to the bank and say that we know that we have a swap with you, but now we don't need it anymore. So can you give us an option to exit the swap? So the bank will say, fine. What they do is they'll calculate the MTM for the swap today. And on top of that, they are going to apply a certain premium. Now that premium is applied to compensate the bank because it is us who has to exit the swap, right? The bank says we have no problem, we can stay in the swap, but we are requesting for an early exit. So the bank is going to charge MTM plus a certain premium, which we have to pay to the bank so that we can unwind that position. And this is what we call as an early unwinding of a swap. So these are a couple of ways in which a swap contract can be terminated. And every now and then client requirements can come in for early unwind or early termination. So these are a couple of ways, but for a normal client, an early unwinding feature, which I said MTM plus a certain premium, that happens to be a very popular technique of doing it because there may not be a very liquid swaptions market in a certain jurisdiction. So at that time, using this early unwinding technique happens to be a more convenient way of doing it. But again, now I've just mentioned three applications here. I'm sure there'll be a few more applications to swaptions as well, but these two, three are pretty popular. And this was my bit on early unwinding of a transaction as well. Okay, so we are at 10:15, 10:17. So do we take a break for 5 minutes and we resume? And then we can start with some discussion on risk management.
Yes,
Yes,
sure.
so that works.
Sir,
Okay.
just one query.
Yes.
So it's regarding exam. We have received previous year question papers,
Okay.
but I guess the first sem was conducted. The first tutorial was assignment based, so
Okay.
we do not have that data. So
Okay.
can you please tell us that whether it will be theory based practical or
So it will be a theory paper because that's what your institute has requested as well. So I think the first paper will be theory. Next we'll see the second periodic lecture.
okay, sir? Because we were really on edge with BSM, so that is why I
Correct, correct,
wanted to ask. BSM is a bit trickier to understand and
correct, correct. No, I mean it will not be very difficult because mainly conceptual questions. So that way, don't worry. It's anyways anything which we discuss outside the classroom will not be there. Whatever things we have discussed during class, we'll figure. So I think as long as you go through that much content, it should be good.
thank you, sir. Thank you very much.
I guess, can we resume? Can we start?
Yes, sir.
Okay. Now, talking a bit of risk management now. So, we'll introduce ourselves to value at risk and then maybe something on the credit side as well. So, starting with VAR or value at risk. Again, a very important metric which you use for risk management for a bank or for a financial institution. The idea for VAR is it helps us estimate one single number, which will give us an idea as to what is the risk for a certain portfolio. So that is what we call as a VAR or value at risk. So let's say there is a statement which says that 99% one day VAR for a position is, let's say, dollars 100. So, if you see this kind of a statement, which typically gets used whenever we are talking of value at risk, something like a 99% one day VAR is $100. And let's say I have one position for which this is the number, or for which I want to relate this statement to. So the way to understand this is that I am 99% confident that over next one day, my portfolio loss will not exceed 100 crores. So this is my confidence level, or confidence interval, or confidence level, whichever we call it. Then this becomes my holding period, and this becomes the maximum loss. So just to repeat the statement, that I am 99% confident that over next one day, my portfolio loss will not exceed 100 crores, $100. So this is how we define a value at risk. So these are the kind of statements which you'll frequently come across in most of the companies' reports or even as a part of their overall MIS framework. But this is the meaning of VAR. Again, here we try and relate this with the distribution side of things. Like we know that whenever we are talking of risk management, we are worried of the left tail of the distribution. So your VAR gets computed on the left tail, whereas on the right tail, we do something else, which we call as exposure. So exposure monitoring is something which we will cover subsequently. But exposures are something which you track on the right tail of the distribution. So if you recollect, we had spoken briefly about MTM plus PFE. So PFE I had mentioned was a potential future exposure, and I mentioned that we'll talk about it later. So once we complete our discussion on VAR, and then we can move on to exposures, because those are related concepts. They're just on the opposite sides of the quadrant. So VAR mainly focuses on the loss on your portfolio, whereas exposure mainly uh, talks about your positive positions which may be at risk, because both are of concern to you right now. A VAR is something which I want to track because I want to track my portfolio losses. If I'm in profit, then no one really worries about VAR. But I always want to have an idea as to what could be the maximum loss which I would be exposed to with a certain level of confidence. Uh, so VAR always focuses on the left tail, whereas exposures are focusing on the right tail. So let's not worry about the right tail of the distribution for now. We'll focus on the left tail and we'll understand value at risk. Now, why is VAR used so widely, and why is it so recognized in the industry? So the advantage is VAR is one single number which helps you understand the risk of a certain portfolio. So let's say I have VAR for a fixed income book. So it may so happen that I have, let's say, 100 bonds in a portfolio of this fixed income, and for that I'm calculating a value at risk. Now the idea is I'm getting one single number which will help me compute what is the riskiness of my entire fixed income position. Now that is extremely convenient, isn't it? Because I'm saying I have 1,000 bonds, let's say. So for 1,000 bonds, I have one number which I can track on a daily basis. So I could have something like a var of t, which I calculate today. I could have var of t minus t plus one, which I did do tomorrow. Maybe I already have a history with me. So t minus one, var t minus two, etc. But still, these are like individual, or maybe they're just one single number, right? So this is today. This is one day back. This is 2 day back, and so on. Or these are time points ahead. So, but the point here to make is I'm just monitoring one single number, which is the var. Now compare this with a scenario whereby I am comparing durations or maybe convexities of these 1,000 bonds. Convexity we don't have to worry much, but maybe durations. So imagine that I have 1,000 number of durations every day. So rather than having one single var, let's say I decide to use duration as a metric, then I'll have 1,000 durations which I have to manage or I have to understand, because each one carries a separate risk of themselves. So that way, monitoring that number can become difficult. Also, at the same time, if I present my management in my MIS report that these are the 1,000 durations, so they'll say, fine, so what? Because and they are not doing the things day in day out, right? They need one number which they can compare. So VAR basically helps you compare the riskiness as of yesterday. So let's say my VAR yesterday was maybe 2 crore rupees. Now today, let's say the VAR has suddenly gone to 8 crores. So that way it's a 6 crore gap. So it's a considerably large change, isn't it? So that means the riskiness of my portfolio has risen. So there can be a variety of reasons. One can be maybe the market variables have moved in such a way which has impacted my VAR. Second could be possibly my front office has added a significant amount of positions in the fixed income book over yesterday. So they have done heavy trading and they have added a lot of positions, which has pushed the risk on my books further, or any other reason. But these two are the most popular reasons for that kind of a movement in VAR. But that way, I mean, keeping a track of how much is the riskiness of your portfolio becomes easy, because now you can simply compare 2 crores versus 8 crores, right? So that 6 crore gap you can easily analyze. So that analysis becomes easy. And that's why we say that it's a recognized metric and methodology is something which participants and regulators prefer. Even managements of banks will find it immensely convenient to have this one single metric, because this metric has been around for a very long time. So that is something which everyone is familiar. So not just the market participants, but regulators also know that, and regulators are familiar with that. And that gives a kind of, or that makes your overall life easy, honestly. Because whenever regulators come for reviewing your models, if they know that you're using something which is very standard, they would not really get into too much of details. And that's always something which anyone will prefer, right? When someone is auditing or reviewing your books, you always want to reveal as less information as possible, or you keep it on a strict need to know basis. So something similar which banks will do with regulators as well. But once regulator knows that it's a standardized structure which they use, then they also won't have too many questions. So both parties are happy. Banks don't have to answer any kind of uncomfortable questions, and regulators also don't have to spend time asking too many questions. But that way, and VAR has been around for a long time and it is stable enough. And that's why we call it as a recognized metric for risk management. And here I've taken an example of just fixed income. But you can have VAR for FX, you could have VAR for options, you could have VAR for equities, swaps, etc. So generally what banks will do is they'll calculate VAR book wise. That's the most frequently used way. So you have VAR for fixed income, VAR for FX, IR, etc., which gets reported separately, and there are limits which are set on top of it. We haven't really spoken about the limits framework, but limits are something which we'll talk about when we discuss exposure monitoring. So at that time, we'll talk about what is limits monitoring and why is limits monitoring required. So request you to hold on till then. But for now, remember that VAR will be calculated separately book-wise, so that banks have a clear idea as to what is the risk of individual asset class which is sitting on their portfolio. Pictorial representation, it is similar to this diagram. We are focusing on the left tail of the distribution. Now, there is one concept which we had studied long back. So I think around 10 or 12 sessions back, maybe in the first 2-3 sessions. So there is an application which I would want to see if you can recollect. So now let's say I have a 1 day VAR number. So let's say my 1 day var is maybe let's call it as var 1D. Now imagine that your boss is coming to you and telling you that I have a meeting with the chief risk officer, and in our discussion we are going to require something like a var 8 days. So, and he'll say that my meeting is in like 10 minutes. So can you quickly tell me what is the var 8 day? So even an approximation is good enough. Yeah, I mean, he doesn't mean that you have to build a 8 day var model, but you already have var 1D and your boss is asking for a var 8D. So what would be a shortcut to do that? Because approximation is good enough. Your boss is not expecting you to do a actual calculation, but something which you can do quickly. So can you relate this with one of the points which we had discussed earlier? Maybe in the first, maybe in the second or third class. So I'll give you a hint. It has to do with scaling of your variables. Yes, anyone? So something to do with scaling of mean and standard deviation.
Not sure.
Okay, okay. So this has to do with scaling of standard deviation with time. Now, why I say standard deviation? Because when we study VAR, let's say I'm looking at this point, the 99 percentile one. So I am looking at deviations away from the expected value, right? Because whenever I have something like a distribution here, I have something like an expected value. Let's say this is my expected value of X. Now, any kind of deviations away from this value is what we call as risk. Now, at the moment, right tail is something which we are not worrying about, but left tail is something which we are concerned with. So we say that standard deviation is a measure of risk because from your expected value, whatever deviations you make, you say that they are a measure of risk for your position. So that is what you try to understand through sigma. So if you recollect in, I think the second or third class, we had spoken about scaling of mean and standard deviation with time. So at that time, we had said that mean scales with time, whereas standard deviation scales with square root of time. So this is the point which I want to use here. Now we are talking of something like a standard deviation, right? We are talking of risk. So if I have to scale my number, I have a var 1D and I want to scale it higher. So what I can do is I can scale it with square root of time. So what I do is a simple approximation is var 8D will be var 1D into square root of 8 days. Or this is square root of time. So I say that var at a time capital T is equal to, let's say, var 1D into square root of time. So this is an application of a concept which you have studied earlier. Now, yes, this is an approximation, but this is all that your boss requests right now, right? Because for a meeting, your CRO is not interested in every decimal of your answer. So maybe your var 8 day through the approximation could come out to be, let's say, 2.7. Now, if the actual calculation gives you 2.5, your CRO is not going to penalize you. It's not expected because you have done an approximation. But that gives a ballpark estimate for the management, right? So generally, these kind of approximations are something which come very, very handy. So tomorrow, it may happen that your boss again comes back to you and tells you that I have a meeting with the managing director, and in MD sir's meeting, we have MD sir's or MD madam's meeting, we have a discussion on VAR 11 days, and the meeting is in like 5 minutes. Now, in 5 minutes, your boss doesn't expect you to build a 11-day VAR model. What you do is you take a var 1 day and you simply scale it by square root of 11 days. And that will give you an approximation of what the var will be for 11 day. And that is something which is good enough for discussion. Now, regulators also stick to standard measures. So generally 1 day var is something which is popularly used for regulatory reporting. So most banks will have a 1 day var measure which is ready. But in case the regulator specifically says that from next month we want you to calculate VAR 8 days on a daily basis, then yes, I mean you'll have a separate calculator for that. But otherwise, for these kind of ad hoc calculations, you don't keep on building separate models because you don't really have that much time, right? You have other things to do as well. So generally, you stick to the things which are required from a regulatory perspective, and uh, whatever slight modifications you have to do on top of this for your analysis, you continue to do. And this is a kind of a shortcut which will help you do that approximation. And this is one of the applications of the concept which you had studied in class 2 or class 3. as a part of this trimester. So any questions on this? Okay. Now, there are many models for value at risk. Now, we will study the one which is most popular amongst markets and something which banks also prefer. So, something which we call as the HSVAR, or what we call as the historical simulation VAR. And HSVAR is going to help us understand what is the risk of a certain position or a certain book. So, to understand this, let's take a very simple fixed income position. So let's say I have a plain vanilla bond in my portfolio and I want to calculate the riskiness of that particular bond. So how much time do we have? Yeah, so we have like 35 minutes. So for the next 35 minutes, I'm going to stay on the whiteboard and I'll show you a demonstration as to how a fixed income VAR gets calculated. And this is the exact process which you'll get to see on an enterprise risk system as well. So HSVAR. And let's take a very simple portfolio. Let's not even worry about portfolio. Let's take a simple bond which you are working on. So imagine that I have a 3-year government security. For simplicity, let's say my frequency is annual. So it's an annual coupon paying bond. Yeah, it should be fine. So let's say I'm a new bank or I'm a small bank and this is my only position. I have one single bond and that to a government security and which pays me an annual coupon. And it has a 3-year term to expiry or term to maturity. And my task is to calculate the value at risk for this particular bond. So this is my task, and I want to do it through the HSVAR methodology or historical simulation VAR methodology. So as a very first step, what I need to do is I need to plot the risk factors which I am exposed to. So for a plain government security, what is the risk factor which I should be concerned about?
Sir, the fixed income fluctuation, like say bond rate is at 5%, so you'll be concerned that the coupon rate may be less.
Correct, correct. So can I say that my only concern should be interest rates? And can I say interest rates are my risk factors? Because these are
No,
the only thing of concern to me, nothing else.
no, sir. It is one of the factors, but usually, as you said, that interest rate is pre-decided when we buy the bond. So yield to maturity, which is subjected to market risk, is a much better,
Correct.
much more deadly
Yes.
risk than interest rate
Correct. No,
fluctuation.
so when I say interest rate, I mean the yields only. So the earlier thing which you said that you call as a coupon. So technically we call that as a coupon. So coupon is fixed. So I have a coupon of C. That is fixed. But yields or interest rates or something are my risk factors. So would that be a correct way of putting it? So is that okay?
Yes, sir.
Yeah. So you can use synonymously. Interest rates or yields, you generally use it synonymously, both mean the same. And coupon is something which will be frozen. Yes. So that is something which I know at the start. So we'll take a plain vanilla coupon paying bond. And that coupon is fixed as well. Okay. So my only uh, now only risk factors are market yields, which I'm exposed to because I know that market yields oblique market interest rates are something which keep on fluctuating. So those will keep on changing. So this is my bond. Now, as a very first step, so now let's label the steps which you are going to do. So step one is firstly fetching the inputs from the system. Because I'm talking of historical simulation one, I need to have access to my historical data. Now that is something which is easy, right? Because I may have an enterprise risk system which has been configured, and that system is going to fetch the closing rates on a daily basis. So so that system can be designed at, let's say, at 6 p.m. every day. That batch process will run and it will fetch all of the closing rates from FIMDA's website. So that way you'll have a daily closing rates which are available for your consumption. So that is something which will get saved in my system on a daily basis. So let's say I have this as T, and let's say 1, 2, and 3. So I have 1, 2 up till 252. So I'll be fetching my 1 year of data. Now 1 year I call as 252. So is everyone clear as to why we say 252 days is 1 year and why not 365?
Work days, no sir?
Correct, correct. So number of business days is 252. So after adjusting for all weekends and public holidays, roughly we come to 252. So 252 is something which we call as 1 year. So the next time you see 252 and people say it's 1 year, they basically mean they're talking of business days and something which they have adjusted for holidays, etc. So I have this data with me already because this is there in my system, right? So I have this table which is entirely filled with numbers. Now here I have not done any kind of exercise. I've simply queried my database and I've taken this data which is already stored in my system. So uh, these are the closing rates as of day one. So let's say I have Z1, Z2, and Z3. So these are my rates as of day one. So let's say these are my zero rates which I have with me. So FIMDA also publishes a zero rate curve which I can use. So I have a Z1, Z2, Z3 as of day one. Similarly, I could have something on day two. So maybe something like a Z1 star or something like that. That way, this entire table is filled. So imagine numbers are there everywhere. Also, let's say that today, end of the day has happened. So I have access to today's numbers. So I'll write today here. And let's say I call this as X, Y, and Z. So these are my closing yields standing today. So as of now, 30th of March, let's say end of the day has happened, and these are my closing yields. So FIMDA has run its process, and this is something which I have with me. Now, this is the data which I'm going to consume. So I'll just highlight that above table header in yellow because this is my input, right? So this has come in from my system, and whereas this is something which I've uh, drawn in from FIMDA. Again, I can highlight this in yellow as well. Again, this is an input for me, just using the Excel convention. So this is simply fetching the inputs. I have not done anything up till now. So this is my step one. So here you'll understand the relevance of having an idea of what risk factors to use. Because if I don't use the appropriate risk factors, that will mean that I am unable to capture the riskiness of a certain risk factor in my calculation, which will have an impact on my VAR number. Now here there is no uncertainty because I have a very simple bond. So I know what the risk factors are. But as the complexity of the product may increase, you need to ensure that you're plotting all of the required risk factors and then you use it in your consumption. So we'll talk about other products in some time, but we'll complete the process first. So this is my step one, just fetching my inputs. Now, going to step two. Here, I'm going to calculate my percentage change in risk factors. So change I'm simply showing by delta. I'm just reducing my writing effort. This is percentage change in risk factors. So I have a T. And I'm calculating a 99% 1 day VAR. So my holding period is 1 day. So day over day, I need to calculate the change. So let's say this is Z1. And let's say this is Z1 star. Let's say this is Z1 double star. So when I say I'm calculating the day over day return, I'm doing something like this. So I'm doing something like a Z1 star minus Z1 upon Z1 double star and so on. So this is what I call as the percentage change in risk factor. And maybe I can call it as a Z dash here. So I think can I just move this here? Can I pick this much? Nowhere to move this. Okay. So I'm doing a calculation like this for each of these risk factors. That is, I'm calculating the day over day returns or day over day percentage changes in the risk factors. So if I do this kind of exercise, how many points should I have? 1, 2, up till, should it be 253, 250, 251? What do you think if I'm calculating a percentage return day over day? So I start with 252 points.
251, sir.
Correct. So there will be 251 points now because I'm calculating returns, right? So I'll have one lesser because I have 252 points, and using the day over day returns, it is going to give me one less. So that's why 251. That is correct. And I will do something like this for each of my risk factors. So let's say I call this as maybe Z2 star. So I do a similar exercise for Z2 star as well. So I'll have a Z2 star minus Z2 upon Z2 star and so on. So that way my entire table has to be populated. So maybe I can call that as maybe dashes possibly. So rather than writing this entire thing, let me just shorten this. So something like Z11. Maybe I can call this as Z12 and Z13. I'm just trying to save space here. So I'm just converting this formula into something which is shorter. But I'm essentially doing the same thing. Imagine Z11 is equal to this. Something like that. Yeah. So I'm simply calculating the day over day percentage changes. That's all I do in table 2. I'll just erase this right section because I'm going to require that space. Now, as step 3, I need to calculate what I call as the simulated RFs or simulated risk factors. Now, why I say simulated risk factors? Because I need to somehow relate these percentage changes, which I calculate in table B, with what is happening today. Because that is what I need, right? I am standing today. So I want to relate to what all things have happened in history with what is current situation in the market. So this Z11, Z12, Z13, maybe I can give these names as Z21, Z22, Z23, and so on. Now, all of these need to be linked with what is happening today. So that is what I call as generating simulated risk factors. So I have already calculated percentage changes in the risk factors here. So I simply scale it using today's numbers. So you can also call this as scaling the RFs, or you can call this as generating simulated risk factors. Both mean the same thing. So I have a T, 1, 2, and 3. 1, 2 up till 251. And something like this. And X into Z11, maybe Y into Z12, Z into Z13, and so on. So basically, through table C, what I try to do, as I mentioned, I'm trying to relate my historical percentage changes in the risk factors with today's numbers. And the idea behind using historical simulation VAR is something which has happened in the past has a tendency to repeat in the future. That's why we have this kind of a model like historical simulation. Through this simulation of risk factors, what I get to do is I get to know that fine. This is how I'm able to relate my historical changes with today's scenario because it is my today's position which I want to measure the risk, right? So for that, I need some way to relate my today's closing values with what has happened in history. And that's why we require this generation of simulated risk factors or RFs. So again, let me just shorten these because I want to use these numbers somewhere. So I'll tell you where. So maybe I'll just write this in a smaller form or maybe in a smaller format. So maybe let me call that as R1, R2, R3 for simplicity so that it saves space for us as well. So let's say this is, let's say R11, R12, R13. Let's say this is R21, R22, R23, and so on. So now I have done this exercise for all of the 251 rows which I have. Now I'll introduce one more technical term which we call as scenarios. So these are what you call as 251 scenarios. So this is my scenario 1, this is my scenario 2, and so on. This is my scenario 251. So these are the technical names which we give to this table. So I have scenario 1, I have the simulated risk factors. For scenario 2, I have a new set of simulated risk factors, and so on up till the 251 scenarios. So are we good up till now? Any questions?
Sir, one question. Sir, I think I lost connection, but What are these values? Z1, Z1, 2.
So Z11 are my percentage changes. So I simply written them in a short form notation so as to save space. So Z11, this is something like, if I can write it here. So this is something like Z1 star minus Z1 upon Z1. So this is equivalent to Z11. I do the same thing for rest as well. So rather than writing this bigger term, I have written it in a short form notation.
So these are the points on the distribution curve, right?
Not exactly the distribution. I have this data already, right? Now, this is coming from my input data system. So I have this historical data. I'm simply calculating percentage change. I'm doing nothing else.
So this is historical one, right?
Yes.
Okay, okay. Now I got it, sir.
So now once I generate my scenarios, the next step that I need to do is to calculate my simulated MTMs. So we'll just plot the next table and then we'll see how to fill that up. So that's called as table D. So I want to know my simulated MTM. So again, 1, 2, up to 250. Now, how do I do that? For this, I have to use a bond pricing model. That is, I can use a simple bond pricing calculator, which will help me calculate what are the simulated MTMs. Why I say simulated MTMs? Because my idea is to calculate the prices for each of these scenarios. So you can imagine I'm trying to calculate P1, P2, and so on up till P251. So in general, I'm trying to calculate PIs. That is, I want to know what is the bond price for each of these scenarios. So now I have said that I already have zero rates with me, so I can directly use them in my calculation. So I'll just write the formula once and we can use it everywhere. So let's say I want to calculate P1 and let's say C is my coupon. So I could do C into e raised to minus R11 into 1 plus C into e raised to minus R12 into 2 plus C plus the face value into e raised to minus R13 into 3. So this will help me calculate price P1. So does everyone agree? C is my coupon payment, FV is the face value. And it's a 3-year bond, which pays out annual coupons. So I've just used continuous notation here, that's it. But otherwise it's a plain bond pricing formula.
Yes, sir.
Okay. So I get P1 here. So can I repeat the same process for all of P251s using the respective rates? So I use the same equation over and over again. So using that, I have my simulated MTMs. So I have a P1, I have a P2, and so on up till P251. So just use the same equation over and over again, and you get the individual PIs. Now, I'll take a step back. Now, I go back to my original table A, and I have today's numbers, right? So today's numbers are X, Y, and Z. So what I do is I price the bond today also. So I use the same equation. Only thing is I use X, Y, and Z directly. I don't do any simulation for this. I simply plug in X, Y, and Z. So in place of R11, you can imagine I have X. In place of R12, imagine I have a Y. And in place of R13, imagine I have a Z. So using this, I calculate the bond price using today's rates. No simulation required. I'll simply call this as P. So let's say P is the price using today's numbers, and I have P1, P2, P3 up till P251 as the scenario-wise prices. Let me just erase this below equation because I'll require the whiteboard. Just a couple of more steps and our VAR thing is ready. My simulated MTMs are done. Now, next is I want to calculate the simulated P&L. So we have table D, right? So table E. Now my simulated P&Ls is nothing but simply taking the difference between my individual PIs and capital P. So that is P minus P1, P minus P2, and so on up till P minus P251. So simply taking differences. So this is what I call as the simulated P&L table. Now these differences, P minus P1, P minus P2, etc., can occur in any order, right? Because I'm simply taking differences. But now what I want to do is I want to arrange them in a certain order. So let's say I want to arrange them in a descending order with the lowest numbers first and the highest numbers later. Because then I can do a simple lookup on this table. Because all that I want to do is I want to have the number which is falling on that 99 percentile thing, right? So, or in other words, I'm looking at that 1 percentile loss, which I'm interested in. So to do that kind of a lookup, what I can do is I can simply sort these numbers in a certain order. So I sort them in a descending order. So sort in a descending order. So I have the smallest numbers or the negative numbers first and then the positive numbers later. And all I'm interested in the negative numbers, right? Because I'm interested in the loss on my portfolio. I'm not really worried about the profits. So I'll have to sort them in a descending order. So I can easily do that. I mean, sorting is not very difficult. So I sort them and I just get a rearranged table. So my simulated P&L. So imagine that this order remains the same. Imagine that my sorting yielded the exact same result. So for now, it's okay. We can just keep it that way. So let's say this is my correctly sorted data series. So I have a correctly sorted simulated P&L. Now my job is to look up at the appropriate number, which will help me calculate what is my value at risk or VAR for this particular position. Now, when I say 99 percentile, I am basically looking at 2.51th observation. Now, naturally, 2.51 doesn't exist because we have integer number of observations. But there are 2-3 approaches to decide on which is my 2.5th observation. So you could either report the third worst observation as VAR, or you could report the second worst observation as VAR, or maybe you could give the average of second and third, and then report it as VAR. So you can use either of these approaches. So market participants choose one of them and they report their VAR numbers. But whatever you do, that has to be consistent. So it should not happen that every quarter you are changing your approach, because if that happens, then regulator or auditors might have questions that why are you changing the approach? Are you trying to hide your losses or something like that? So that way, whatever approach you decide, try to stay consistent with that and don't change it very frequently. And if even if you do have to change it, then you should have some kind of a rationale as to why you're switching that approach. But this is how, now once we do this kind of a lookup, I have the VAR for my fixed income position or VAR for this particular one. So any questions in this approach?
Yes, sir. Sir, as you said that we are only concerned about negative return. So it would be a single tail distribution curve, right? If we plot it.
So what we do is we plot the entire simulated P&L. So you can imagine that to be like a distribution of values, and we will focus on the left side of that value or the left tail of that value. We will not worry about the right side. When I say right side, basically positive numbers.
Okay, sir. Okay.
And generally at the time of reporting, we report this number to be a positive quantity. And we know that it's a loss, but generally when you put it in a MIS report, you generally show this as a positive number. So you basically take your VAR and multiply it by -1. So that basically reports your VAR in a positive quantity, because everyone knows that VAR is a loss. But for your limits monitoring, etc., you have a positive limit which is defined. So for making the comparison easy, you simply convert that into a positive number and then you use it.
So that means we are just denoting a probability of loss, basically.
Of course, yes, yes. Everything is probabilistic because standing today, we are trying to estimate what will be the loss tomorrow or maximum loss tomorrow.
Okay, sir. Thank you.
Now, this is like a generic approach. So you can apply this for any product which you have. So we have discussed this for a plain vanilla bond. You might want to apply this for a swap or maybe for an option, etc. Now, approach remains the same. Only thing that will change is you have to ensure that your appropriate risk factors are mapped. So here we are just 3 risk factors. For options, you may have a few more. So maybe if it's a FX option, you have FX rates, volatilities, etc., which come in as inputs. So ensure that your risk factor table is up to date and you have the required risk factors which are mapped. And next, you'll require a option pricer. So let's say I'm talking of an option VAR. Then for calculating this simulated MTM, I will require an option pricing engine, which will help me calculate P1, P2 up till P251. But otherwise, the process doesn't change. The process will be same for other products as well. So the advantage is once you have this process set, even if you just tweak on the risk factors and the models which are used, then VAR calculation becomes very, very easy. So maybe the next time when we meet, I'll try and put a small example in Excel. I'll do things manually, but that should be fine. I mean, we'll at least know how exactly these things happen. So it will give you further clarity. So that is something which we'll cover in our next class.
Sir, won't the Monte Carlo simulation be a better estimate than historical data?
Now it depends. So basically, there are pros and cons to both of them. So the advantages for historical simulation is firstly, it's easy to implement. It saves a lot of time and it's very difficult to make mistakes because that way it's a very standardized process. So generally, whatever numbers come in through a historical simulation VAR, these are something which everyone accepts easily. So be it a trader or be it a regulator auditor, they don't have too many questions because there are no assumptions, right? We have not done any separate assumptions here. So convincing your parties that this is the riskiness and also using them in your analysis gives you a kind of confidence. But for Monte Carlo, yes, there are advantages, obvious advantages, because for historical simulation, we are working on a standard window, right? We are just working on 252-day window. So there may be certain events which have happened outside the window, which are not getting captured. So that's always possible. So that's a drawback, yes. But for Monte Carlo, the advantage is it gives you a chance to simulate multiple scenarios. So here we have just 252 scenarios. Now for a Monte Carlo, you could have maybe 1 million scenarios. So naturally, it will give you a better probabilistic estimation. But the thing is, Monte Carlo simulation is comparatively challenging. So when I say challenging, both from a technical standpoint as well as from a system implementation point of view. So why technically? Because Monte Carlo simulation and what we have done was easy, the equity one. But when you do it for interest rates, etc., it becomes difficult because then you have interest rate models which have its separate assumptions, etc. And the Monte Carlo simulator itself will have a certain assumptions of its own. And then it generates the paths, etc. The approach will be similar. So we'll talk a bit about Monte Carlo in the next session. So I'll give you the steps which are followed. Now, the thing is, the results of Monte Carlo, firstly, they are open to interpretation because we use multiple assumptions in a Monte Carlo calculator. So it may so happen that risk management has used a Monte Carlo simulation and they find that the VAR for a certain portfolio is breaching. So they'll approach the trader saying that your portfolio VAR is breached, so we want you to take corrective action. So maybe trim down your positions, etc. Then the trader may say that if I use this set of assumptions, which are again acceptable, then my VAR is not really getting breached. So I am on the right side. So then it gets into a discussion. So that way, the more the number of assumptions, the more the discussions it will be, and it will be difficult to come to a resolution. And the second thing about Monte Carlo is it's a very system intensive activity. So it takes a lot of time for a Monte Carlo VAR to run. So if your system infrastructure is limited, then you have to allocate that memory for your other mission critical activities also. So maybe using a Monte Carlo VAR on a daily basis might not be feasible. So I think that can be a hindrance to your daily monitoring. So I think that is how I would look at historical simulation versus Monte Carlo.
Okay, so thank you.
All right. Okay, good. So good. We have introduced ourselves to VAR. Now we know what is value at is. So so good. I mean, we have discussed a good technical idea today. So something which we'll demonstrate through a simple Excel the next time. And but I mean, this is like an important metric which will frequently find everyone being using. And in the next session, we'll talk a bit about stress testing and back testing for VAR and why do you do that as well. And then a few applications of VAR and as to why VAR becomes useful. So we have already discussed that, but a few more points pertaining to it. And then maybe we can go to something on credit ratings and subsequently following up with exposure monitoring, etc. So that is something which we'll cover in the next session. So we'll stop here today. So let me just take the attendance. So Akash Singh, Achal Jain, Ayush Bhushan, Adesha Hathi, Tejas is present, Ali is present, Anjali Garg, Anmol Sen, Arispita Deka, Avni Mishra, Ayushi is present, Ayushi Rotagi is present, Sarvesh is present, Bhavya Dang, Cherry Chabra, Isha Chauhan is present, Dipancha Singh is present, Gaurav Kadam is present, Gaurav Datir,
Present, sir.
okay, Himanshi Verma is present as well, Jaideep Saini, K. Ayushi,
Present, sir.
Riya Shukla, Priti Marwa, Mansi Singhal, Mansimran Arora, Manvi Kukreja is present,
Yes, sir, present.
Mihir is present, Muskan Garg, Namrata Gaur, Neil is present, Nikhil Agarwal, Asun Sharma, Pratik is present, Rachit Tyagi, Rahul Ghosh, Rahul Giri, Rahul Goswami. Yeah, Neil, I have marked you present already. Yes.
Thank you, sir.
Yeah, Rajaditya is present.
Yes, sir, present.
Okay. Rashi Jain is present. Rishabh Kothari, Roma Keshri, Sahaj Manocha, Samiksha Chopra, Charanya is present. Shubham Jain is present. Shubham Kumar, Someshwar Verma, Stuti Mehrotra, Sanika Thakur is present. Vinay Pawar.
Present, sir.
Okay. Yeah. So if you guys, your attendance is done, you guys can leave if you have a session after this. And we'll meet tomorrow. So we have a rescheduled class for tomorrow, and we'll meet at 4:30 because we are missing our class on Saturday. So because it's Gudi Padwa, so we'll do it tomorrow. So I think Shrikant sir has already scheduled the session and the meeting invite has been given. So I'll meet you guys tomorrow. I'll quickly take the attendance for IB.
Thank you, sir.
Thank you. Ayush Sharma is present.
Present.
Yeah. So I'll read out the names, and if you're present, please let me know you're present. Alisha Gupta, Vidhi, Anant Jain, Anish, Anjali Sethi, Arshada, Barkha Israni, Bhavya Patel, Saloni, Chaitra Tirolkar, Deva Pandey is present. Isha Kalra, Gauraja Nevatia is present. Gayatri Narkede, Govind Mittal, Sawan is present. Himanshi Virmani is present. Indu, Ishita Saxena, Kanika Goyal, Karthik Mittal, Khasro L. Laksha is present.
Present, sir.
Mahi Rajawat, Mansi Gupta, Mathangi Warrior, Megha Parak, Nancy Alawat, Neha Jain, Pratishtha Pradhan, Rohan Bagai, Rohit Poddar, Samita Malik, Shivangi Semwal, Simran is present. Srishti Verma, Tanu Goyal, Tarang Kadyan, Yeah. Kalyani Tolkari, Twinkle Karnawat, Vaishnavi Shrotya, Vanishka Jain, Vibhor, Vidushi Rana is present, and Yash Mehra. Okay. All right, great. Thank you so much. And okay, yeah, Arshada is also present. Okay, I'll mark Arshada present. Yeah, thank you. All right, thank you so much, and I'll see you guys tomorrow.
Thank you, sir.
Thank you.
Thank you, sir.